Have you ever wondered how much tax you're going to pay in retirement and how your taxes are calculated on the likes of your pension, state pension and savings income? When you're working, and let's assume you were employed, it's fairly straightforward as you probably pay tax through PAYE, but when you retire, things can be a bit more confusing. In today's video, we're going to look at how the various retirement income streams are taxed, and we'll also give you a few examples and scenarios of different income streams that you can use for your own situation to work out your potential tax bill. I'm also going to share a few tricks and tips that you can use to reduce your tax bill that you might not be aware of. Before we look at the tax system, we need to quickly explain how pensions work. Let's start with private pensions. So starting with your pension tax-free cash, as you may know, you can typically take up to 25% of an uncrystallised pension tax-free. This is known as a pension commencement lump sum. You don't have to take the tax-free cash all at once. It's possible to take a series of smaller tax-free lump sums or even a tax-free monthly income. Once you've taken all of your tax-free cash, you've crystallised your total pension fund. Once you take any crystallised pension funds, these will be classed as taxable income and taxable at your marginal rate. Well, does that mean you automatically pay tax on the withdrawal, and if so, at what rate? Not necessarily. This is because it's going to depend on other taxable income that you may have, such as your state pension, final salary pensions, employment income if you're still working, and rental income, to name a few. Don't forget that the vast majority of people will have something called their personal allowance. This is where the first £12,500 of your taxable income is taxed at 0%. Assuming you've got no other income, if you take this amount of your income from your crystallised pension, even though this is taxable income, as it's within the personal allowance, the effective tax rate would be a great whopping big 0%, so effectively tax-free. If you live in England, Wales or Northern Ireland, there are effectively 3 tax bands and rates that you can pay tax on that you need to be aware of. Basic rate, higher rate, and finally the additional rate. Let's start with the basic rate. So the basic rate tax threshold is a little over £50,000. This means any income above the personal allowance but within this threshold amount of 50k is taxed at the basic rate of 20%. Let's see how that kind of works then. So George, he's still working and his employment income is conveniently £12,500, which takes up all of his personal allowance, which, as we know, is taxed at 0%. So he takes a 5k lump sum withdrawal from the crystallised pension, which, if you remember, these funds are classed as taxable income, and so the basic rate tax will be due, which equals £1,000 in this scenario. So how about if your income pushes you over the basic rate threshold? Well, any income between £50,270 and £125,140, this is taxed at 40%. Finally, if you have any income above this amount, well then it's taxed at 45%. So what kind of happens then if you straddle one or more tax bands? Let's see how this works. So John, he's about to retire. His only income is going to be his state pension, which is the full amount of, let's call it £11,500 per year. In addition to his state pension, his private pension is valued at just over £1 million, and it's now fully crystallised as he used the tax-free cash to buy a Lamborghini. So he needs an extra 60k to meet his expenditure this year. So in total, his income is going to be £71,000 this current tax year. So what income tax is he going to pay? What tax is he going to pay on that drawdown withdrawal? So he has his full personal allowance remaining. So we need to take £71,500 and deduct the personal allowance amount of £12,500 from this, which is taxed at 0%. This means around £58,930 of his income is going to be subject to tax. So we take the basic rate threshold of £50,270 and deduct the personal allowance of £12,570, which means £37,700 of the income is going to be taxed at 20%. So the basic rate tax due is £7,540. What about the rest of the income that's above the basic rate threshold? So we take £71,500, deduct the basic rate threshold of that £50,270 from this, and so £21,270 £230 is going to be subject to income tax at 40%. This means the high rate tax is going to be £8,492. So in total, to combine the basic and high rate tax, the tax is going to be around £16,032, and his net income after tax will be £55,468. This gives him an effective tax rate of around 22%, despite, of course, being a high rate taxpayer. Too often I'll hear people who think that as they're a high rate taxpayer, every penny of their income is taxed at 40%, when this isn't the case. Just to add further confusion to the fire, if your earnings and you're lucky enough to earn above £100,000, then your personal allowance is reduced by £1 for every £2 over this limit. In other words, if your income exceeds £125,140, then your personal allowance, the amount of income which is taxed at 0%, is removed entirely. This is often referred to as the 60% tax trap, as not only is the income being taxed at 40%, but you're also losing some or all of your personal allowance, meaning the income that was previously tax-free is now subject to income tax. Yes, in theory, however, there are scenarios in which the state pension may be tax-free for you. So the state pension, it comes to around £11,500, and yes, the state pension is classed as taxable income. However, if you remember back to earlier, the vast majority of you will have the personal allowance available. So what does this mean? Let's take Helen, for example. Her only form of income is the state pension, which comes to £11,500 in her case. As it's within the personal allowance, effectively the state pension is going to be tax-free for her. How about if Helen took a drawdown from her crystallised pension for £4,000? In this situation, we add the two forms of income together, which gives her a total combined income of £15,500. We'll then deduct the personal allowance from this amount, which means £2,930 of her income is going to be taxed at 20%, giving her a total tax bill of £586. Let's assume that Helen's private pension from which she took this withdrawal was valued at £100,000. She had previously taken £20,000 tax-free, and so had crystallised £80,000 of her pension. If we assume Helen again needed to take that 4k from her pension to live on to top up her income, how can she do this as tax efficiently as possible? So Helen, she's got £1,070 of her personal allowance remaining. She can take this from her crystallised pension, and although these funds are classed as taxable income, both this withdrawal and her state pension are within her personal allowance, so effectively this withdrawal is tax-free. However, if we remember, she needed the 4k and we've only gone and taken £1,070 from her pension, so there's still going to be a shortfall. What can she do about the difference? So £20,000 of her pension is still uncrystallised, and she can take £2,930 from her pension tax-free to create that tax-free £4,000 withdrawal that she needed. In terms of how this works, she's going to crystallise £11,720 with £8,790 moving over to her crystallised pension. Let's call it £8,000 of her pension is still uncrystallised in her pension, and she can take 25% of this amount tax-free in the future should she wish to. Interestingly, on the state pension and the personal allowance, the state pension only has to rise by 10%, and with the personal allowance now frozen for a few more years confirmed by Labour, this means it's going to drag many millions of pensioners who were previously not paying tax on their state pension above this personal allowance rate. This is often referred to as fiscal drag. Interestingly, the Conservatives just before the election promised to increase the personal allowance for pensioners to try and win votes, but of course we know how that election turned out. The majority of taxpayers can earn a certain amount of savings income tax-free, which is known as the personal savings allowance. For basic rate and high rate taxpayers, this allowance is £1,000 and £500 of your first savings respectively for basic and high rate earners, which can be earned tax-free. For additional rate taxpayers, there's no saving allowance available at all. So if your savings income exceeds the savings allowance, then it is taxed in the exact same way as income. Let's see an example. John, he's got a salary of £53,000 and he receives £1,000 in savings income. So he's a high rate taxpayer. So what tax does he pay on the £1,000 interest? So we take off the personal savings allowance, which means £500 is basically taxed at 40%. However, there is a caveat. If your income is less than £17,570, then your starting rate for savings, the amount that's tax-free, is £5,000, which can be earned tax-free. For any income above the personal allowance, the starting rate of savings is reduced by £2 for every £1 over this limit until you get the standard savings rate allowance for basic and high rate taxpayers. Let's see an example. So Karen, she's retired with no other income as the state pension hasn't kicked in for her yet. As she was a good saver, she's hoarded 400k in her bank account. The interest on this account is 4%. She's locked that in, so let's call the interest £16,000 or so. What tax are you going to pay on this? So we deduct the personal allowance from this amount, which means £3,430 is above the personal allowance. Will she pay tax on this amount? No. That's because she has the full £5,000 starting rate of the savings band available, which means the income, savings income, is effectively tax-free. That's why it's really important for couples to consider each of their incomes and see if the starting rate of savings is available for one spouse, so you can take advantage of this by transferring money, or even if one spouse is a high rate taxpayer and one's a basic rate taxpayer. The big change to inheritance tax following the budget is that from 2027, pensions will now be liable for inheritance tax and included in your estate. Begs the question, how is inheritance tax calculated? Each person has what's called a nil rate band, where the first £325,000 of their assets are shielded from inheritance tax. If you're married, this nil rate band is available for both spouses, and assuming one spouse leaves everything to the other spouse, the nil rate bands can be combined to create a total of £650,000 in which no inheritance tax is charged on. Furthermore, if you leave your main residence to your direct descendants, such as your children or grandchildren, an additional residential nil rate band is available for each individual, for each spouse. This adds a maximum of £175,000 per spouse. This too can be combined, meaning that a couple's estate will pay no inheritance tax if their total estate is worth £1 million or less. Regarding the residential nil rate band, if the property was only worth, say, £250,000, then that would be the maximum amount eligible for the residential nil rate band. To illustrate the importance of the changes to pensions now being liable for inheritance tax, let's look at an example with Fred and Becky. So Fred, he predeceased Becky and left everything to her. Becky's assets at the time that she died included the family home worth £600,000. She had £300k in savings and a pension valued at £500,000. Before the budget change, the pension would be outside the estate entirely, so the total value of her home and savings will be below £1 million, meaning no inheritance tax would have been due. After the budget change in 2027, her pension is going to be included in the estate, making her estate's total value £1.4 million. With inheritance tax charged at 40%, the IHT due would be £160,000. For retirees with substantial pensions, this change presents a financial planning challenge that may catch many people by surprise. For estates above £2 million, the residential nil rate band, the £175,000 per spouse, is reduced by £1 for every £2 over this £2 million threshold. Put another way, if your estate's over £2,350,000, the residential nil rate band is removed entirely. Instead of potentially £1 million being protected from inheritance tax, only £650,000 will be protected, which is a real big change for those bigger estates. If you own a rental property or properties and hold them personally, this income is going to be subject to income tax. Take Philip as an example. Phil became an accidental landlord when he moved in with his partner, and he now rents out his flat for £5k a year. With no other income, his tax bill would be zero since this income is within the personal allowance. If you want to know how drawdown works in more detail, watch this video which goes into it here.